All right. Thanks everybody for hopping on today. I'm going to share my screen. My team always gets on me. I always like to share. I like to share music when I have some sort of conversation, but they say sometimes it's too loud. I chose for us today a motivational music because when you talk about taxes, why not? Why not have some motivational music behind it? I'm joined today by Drew Kitchens. He's one of our he's my business partner, fellow CPA, tax strategist, and DPC enthusiast. I guess you could call us that.
Yeah.
How we just love what you guys are doing on the DPC front, making a difference in healthcare at Goodman CPA. Our goal is to help support DPC owners to be able to build more sustainable DPC businesses. And one of the great ways to do that is actually through taxes itself. So we're going to flip over. We'll just do a quick introduction of the two of us. If you don't know me or haven't met me, I'm Nate Goodman, founder and a CPA. I also have an MBA. Started Goodman CPA back in 2019 and started working with my first DPC doctor back in 2021, who really helped me get a better get better access to healthcare myself for my own family and now for my team. Each of our team members are also members of DPC practices. And I uh, write content, speak at conferences as much as I can to try to provide what I can to the DPC community from a CPA's perspective on accounting and business finance and business strategy. And so um, that's my background. I still work in taxes and help the team as we go through tax season. Our company helps provide monthly accounting, tax advisory services where we meet quarterly, and our whole function is to be just like a DPC but for accounting. So, Drew, I'll let you introduce yourself a little bit as
Yeah,
well, and then we'll dive in.
of course. Thanks, Nate, and thanks for having me, guys. So my name is Drew Kitchens. I'm located here in North Carolina. I have a master's degree in tax. Originally went that route and focused in healthcare practices and worked with a lot of transactions in the private equity space and a lot of that stuff that's going on there. I was introduced to DPC through working with Nate and getting to know him 3 years ago, and now it's been fun. I work with DPC practices on a daily basis with the whole goal in mind, whether it be taxes, cash flow, monthly financials, forecasting, budgeting, all of these things, right? The goal is to make these DPC practices as financially viable as possible, right? We have a lot of high earning doctors that come into DPC and and want to make it work, right? A lot of the draw is not all the times it's not necessarily financial, right? But it's more the quality of care that they can provide patients. And we want this to be a financially viable business model, and that's what we're passionate about, and that's what we do here.
Awesome. A few housekeeping items. If you have questions for us, you can put them in the chat. If you just click the little chat button up at the top. There's also a Q&A function in there, which I'll check both of them periodically, but either chat or Q&A work just fine. And at the end of the conversation, we will have a time where you can pop on as well and give a verbal question if you'd like. So today, our goal is for you to walk away with the 4 pillars and see the 5 common mistakes that we typically see when it comes to reviewing tax returns for DPC owners, and then give you one clear next step of what you could do to make yourself and put yourself in a little bit better tax position. So the first thing we'll walk away with is the tax saving habit. This is a monthly rhythm that makes April stop being a surprise. Number 2 is right entity at the right time. We get a lot of questions about S-Corp. And so if you have questions about that, we'll be addressing the S-Corp question here today, what we recommend from our perspective. And then we'll talk about HSA and DPC under the OBBBA, what changed in January for you and your patients, and then some new wins and opportunities that you guys can take advantage of this year in 2026. So now we're really looking forward now that we've passed April 15th. Most of you are probably have gotten your tax return or hopefully have gotten your tax return, and you either got shocked with a big tax bill or you're just saying, hey, I'm trying to find that next little thing that I can do to make my business just a little bit more efficient and save a little bit more on taxes, because that is probably one of your number one expense lines on your personal financial statements. Why is DPC tax planning any different than maybe generic small business advice, which leaves some money on the table for DPC owners? So You guys have a subscription revenue versus traditional services and healthcare, so you're not fluctuating income based on claims made. The monthly recurring revenue changes how quarterly estimates are paid and how to calculate those. It affects your QBI, and it affects how entity planning should work as well, because there's opportunities for DPC owners within that. The SSTB classification for health services. This is a specified service trade or business, which means uh, for qualified business income, that's a really big deduction that you can get on your 1040. This classification is limiting, and it's people that have the SSTB classification are for anybody that is not a butcher, a baker, or a candlestick maker. That was a term I got from my CPA exam. Instead, it's all reliant upon the expertise of an individual or a person through services. So that affects DPC owners. HSA and the DPC integration affects your DPC fees. Hopefully, you're seeing an increase in clients coming in because they can now use their HSA. And then most owners are the clinician, the operator, and the leader of the business. And so reasonable compensation has to reflect all three roles. It's not a default to what some people call the 60-40 rule, which is just a rule of thumb and is not actually an approved rule from the IRS. So we'll dive into those, but that's some of the big reasons why DPC tax planning is different. So let's talk about the tax saving habit. This is something we've started to incorporate in how we train our own clients on a regular basis, but this one habit really provides a lot of peace of mind around taxes. And whether you're a client of ours or a client of another CPA, the question we often get asked is, well, how much should I set aside for taxes? And if you get in the habit of setting aside 25 to 30% of your net profit every single month, this is a rule of thumb, but it's helpful because if you set aside and go, let's say you have, every month you have $10,000 in net income. When you look at your profit and loss statement from your bookkeeper, or if you're keeping your own books, or if you're getting your financial statements from your CPA, if you look at the bottom line, that net income, most of the time, all the expenses on that profit and loss sheet are deductible. And so setting aside 25 to 30%. So if I had $10,000, I would take 3,000 and I would put it into a separate high yield savings account. Then if I pay quarterly estimates, it's going to flow out of that tax savings account. Also, if I get to April 15th and my CPA says, oh, hey, by the way, you owe $30,000 because this is maybe your first year being self-employed, you've got that money set aside and there's no more last minute scramble or panic moment. It also helps you get in the habit of knowing, like, hey, every month I'm making money, every month I'm paying taxes into my tax savings account. This one is definitely one of the single most effective habits that helps improves our physician owners' relationship with money more than any other change, because there's not this like looming, well, that is, April 15th is coming, so I got to be careful. So if we can reduce anxiety about cash flow around taxes, we're not scrambling to make, pull money together for quarterly estimates. It's going to help you build a more effective practice because you know the money you have to invest back into the business that's not touching your taxes. I'm going to let Drew talk about right entity and right time and when we actually recommend people make this jump from maybe a single pass through LLC. So if you want to just give us an overview of the different types of entities, Drew, and then talk about maybe people who switch too early versus the sweet spot of when it makes sense to switch.
Yeah, yeah, thanks, Nate. So one of the main things that you see in professional services is the idea of an S-Corp, right? So generally with more capital intensive businesses, but it's not always the best move. But by and large, if there was a more often than not situation for doctors, lawyers, CPAs, an S-Corp would be it, right? In DPC, there's a lot of doctors that are just starting out, right? With the S-Corp election that is made, generally by a CPA, there comes complexity. There comes another tax return. There's a whole other set of rules that have to be followed. And so we have to make sure that we're doing that in the right time so that we're not overcomplicating your tax situation before you have the earnings to really benefit from the tax savings that an S-Corp can provide. Some of the risk of switching too early is if you're not really dealing with any payroll filings and you don't have any net income, you don't necessarily need to pay yourself a salary. Generally, we would say if someone is, doing around $80,000 net, it would make sense. And I'll explain why that is. But before I do, I want to talk about the compliance burden a little bit. So an S Corp has to file a separate tax return. You have to keep a corporate governance rules that you have to follow as if you were a corporation, right? You also have a reasonable comp requirement. Nate kind of alluded to that with the 60/40 rule. That's a popular way that most CPAs do it. It can often result in overpaying. But one of the main things that professional services benefit from in being an S Corp is the reduced self-employment tax. So if by default you were just a single member LLC, so you one doctor owned an LLC, you made $100,000, right? You would pay all of the income tax on $100,000, but in addition to that, you would pay 15.3% in self-employment tax. So if any of you guys have been W-2 wage earners in your career, you guys are familiar with Social Security tax, Medicare tax, unemployment, all of those things. What self-employment tax does is that's the way payroll taxes are paid for self-employed individuals. So the biggest part of that is the Social Security, but then you have the Medicare and the unemployment and the other pieces that get you to the full 15.3%. And so as a self-employed individual, you're covering 100% of that. If you were a W-2 employee, you would only be paying half and your employer would cover half. The main way that you can save money on self-employment tax or payroll tax as a S Corp is, let's go back to our example of $100,000 in net income. And this is why we use the $80,000 rule. Nate has a perfect example here, right? So say you have $200,000. Let's raise it up. $200,000 in net profit on a Schedule C, and then you have $200,000 of net profit on an S Corp. In your Schedule C, you wouldn't have to pay yourself a W-2 salary because you wouldn't be an employee of the company. You would be the sole owner, and that wall between business and employee is a lot more loose, right? You would have a self-employed tax base of $200,000, but in this situation, on top of the income tax you pay on that $200,000, you're going to pay $28,260 in tax, right? That's not income tax. That is above and beyond that. Under the S Corp, you're only going to pay that payroll tax or self-employment tax on what we pay you as a W-2 salary. Our team does a lot of work to optimize what that number is and to try to get it as low as possible for doctors. We have some special methods that we use to do that, and we don't kind of default to an estimation and we annualize it or we estimate it throughout the year. But an S Corp who has $200,000, the same $200,000, if we paid you a salary of $80,000, which is how we're getting to that figure of where it starts to make sense, and that's the break-even point, and you would take distributions of $120,000 to get the full 200 out of the company, you would only pay self-employment tax on the $80,000. Therefore, saving substantially here, right? Saving $16,000 on just a simple election and how your business is structured. Now, the risk of doing this too early is if the savings aren't there, and then you're paying for an extra tax return. If you pay per return to your CPA and they operate under that model, you're likely paying an extra $1,500, $2,000 a year for that tax prep, and you're not saving the tax. And on top of that, you're having to run payroll. You're having to do all of these other administratively burdensome things while you're trying to grow your practice. So that's why it makes sense to do this at the right time, but it's still a substantial tool. And Nate showed you here an example of $200,000 in net profit, but the savings only goes up, right? So that's $300,000 in net profit. That $12,000 would increase slightly, and the $28,000 would increase exponentially, and that $16,000 savings would only increase.
Yeah, I usually like to tell people we were just at the pediatric DPC conference this last weekend, and one of the things we talked about was like a Schedule C. Even if you're an LLC, the default, if you haven't elected anything, is that you will file as a Schedule C. A Schedule C goes on your 1040. It's one tax return. It's just an additional piece of paper that goes with the 1040. And the IRS sees you and that LLC as one and the same. So you can't be an employee of yourself. When you elect S Corp, what you're doing is you're separating out, in the eyes of the IRS and the state tax agencies, you're separating out yourself from your business. And so now the business is its own entity and it's filing its own tax return. Therefore, you can become and have to become an employee of that S corporation while you are also a shareholder of that S corporation. And so you can get distributions as a shareholder and you get a salary as a W 2 employee. And so that's like a big distinction between what is the S Corp to a Schedule C. And then reasonable compensation, again, it's very important that we don't just say, well, I'll just take 60% of my net income and pay it to me as a salary so that I'm always, making sure I'm not paying more self-employment taxes than I need to, but I'm also paying enough that it's not like I'm trying to avoid self-employment taxes. Instead, when you run reasonable compensation studies and actually say, I was a janitor for 5 hours and I was a marketing person for 5 hours out of a 40-hour work week, you're not a doctor or a CEO 40 hours a week. So that reasonable compensation study is really helpful. And we also see that happen with people that are already an S corporation. There's a lot of savings opportunities by doing reasonable compensation studies. One other distinction is I get a lot of questions in one of the boot camps that we do. It says, well, my state requires me to be a PA, which is a professional association, or a PC, which is a professional corporation. If your state requires you to be a PA or a PC, you actually become a C corporation by default. And so in that case, it actually can make a lot more sense to be an S Corp right out of the gate, because otherwise at the C Corp level, you're going to have to take everything as W-2, or you're going to get double taxed when you take that money out of the company as a dividend. So that's one other caveat that we typically see in DPC, because you guys are professionals and have to form some sort of professional company in those states. There are a few states that only require a simple LLC. You don't have to go through your state board. But so I'll talk through HSA and DPC, and then Drew's going to walk us through some of the new strategies that we found with the passage of the OBBBA, as well as some simple strategies we use with most DPC owners. The HSA integration went live, so January 1st, 2026. DPC memberships qualify as HSA medical expenses. What's important here is for your patients, they can now use their HSA to pay for the DPC. It's removing a really big objection to enrollment. Common question I'm getting asked right now is, can a DPC membership now qualify under Section 125 as qualified employee benefits? Does it have to have, is it a pre-tax benefit for employees? And the answer to that right now is it's not clear. The IRS hasn't published clarification in their FAQs to say, yes, DPC memberships are also considered qualified health benefits. But with it being qualified for HSAs, I think we see a roadmap for where we could get to them also approving it under Section 125. For you as the owner, we do have DPC owners that actually have traditional health insurance. You can contribute to your HSA and use it for a DPC membership at another practice if that's how you receive care also. The limits rose to $4,300 for self-only HSAs and $8,550 for families in 25, and that increases again in 2026. This is an above the line deduction. That HSA, when you put money in, if you put in 8,500, it's growing tax free. And then when you take it out to pay for qualified health expenses, it's also coming out tax free. So not only are you getting a deduction on the front end when you put it in, it also is growing tax free and it's also coming out tax free. So it's like a super powered tax saving vehicle if you have a high deductible health plan. And if you're like, hey, well, I use a health share and I use a DPC membership for my health coverage, there are companies that are starting now that are high deductible health plans that are like extremely cheap on the premium side that are qualifying to be able to put money into an HSA. And so you could still keep your health share and your DPC membership while also opening one of these cheaper HSA plans to be able to still do the HSA strategy and get money into it. So some things we recommend owners to do, DPC owners, update your member-facing materials, highlight that you're HSA eligible. You know it because you're in the DPC community, and we know it because we're CPAs. But the general public isn't like oohing and ahhing over tax strategies and the DPC movement like we are. And so it's helpful when you have that material available in your education to be like, hey, if you have an HSA, you can also pay for it that way to get better health care. So review your billing structure. Admin fees and non-medical add-ons have to be billed separately. And then maxing out your contributions in 2026. So also talking with employers and brokers in your areas now as this HSA plus DPC is a great benefit package to add to the story of how you educate people on DPC. All right, let me find my mouse. All right, OBBBA wins for DPC owners. Drew, you want to walk through some of these business side wins?
Yeah, I can. Yeah, I won't go too much into detail. What I want to do is just provide a general understanding that the tide is turning in tax. Nate kind of touched on that with the HSA involvement in DPC now and how those are now eligible expenses. And so the tide's kind of shifting in terms of DPC, right? Like where legislation is starting to favor the movement. But also it's a great time to be a taxpayer with some of the things that are going on, specifically in the OBBA. One of the main things, and perhaps the biggest thing that's helped most businesses is that 100% bonus depreciation has been restored, effective after January 19th, 2025. So anything you purchased after that date can now be fully expensed. So think equipment, exam tables. This is huge for people, for really multiple sets of people. But if you're starting out your practice and you have to buy an exam table, you have to buy these things, right? DPC isn't extremely capital intensive. But maybe you have to build out your space a little bit to make it optimal for seeing patients. And all of that stuff can be expensed in the first year and help you in terms of cash flow to make sure that you're not getting hit with a huge tax bill as you begin to make money. This is also great for people who are looking to build out into a different, line of work, right, or a different add-on, right? Like if you're looking to do aesthetics, right, and you want to get really into that and get like an Agnes machine, right? Like that can be great. Those are expensive, and you could really curb some of the cost of that, right? View it as getting it, 20, 30% off with the tax benefit that you'll get. The same thing goes for if you want to get into wellness and get a DEXA or something like that, or any number of things that you want to do. This could be a great time to do that while that benefit is in place. You could really save on tax there. So salt cap relief in the 2017 tax bill that the Trump administration pushed through, there was a limit on high income earners. Well, really, it was on everyone, but it really hit high income earners where they could no longer deduct state taxes that they paid above $10,000. So on the itemized deduction schedule, Schedule A on your tax return, you and your spouse's state income tax that was withheld, as well as property taxes that you pay on any real estate that you own, taxes you pay when you renew your tag, right? All of those taxes were now limited to $10,000. Because of that, a lot of states came out with an election where you could pay the state tax for, say, an S-Corp or a partnership at the business level, and then take the deduction that way. And it was kind of a workaround to the federal limitation. The federal government kind of realized that was going on, and so they've now raised that limit. And so it's added a lot more flexibility. What we do with our clients now is we help them optimize that. There's different situations when each can be more advantageous, and so you really want to make sure you're working with a CPA that's working with you throughout the year to make sure that's optimized and you're not missing deductions there because that could be substantial. Another thing that came out of the OBBBA is the 20% QBI deduction. Is now made permanent, right? So that was set to sunset There's now a $400 minimum deduction for active business owners. And they also raised the SSTB thresholds, which is huge for doctors across the board, and DPC owners alike. The final thing we have here is the child care credit explained or expanded, sorry. 40% of the credit on child care expenses up from 25%. So you get an additional 15% if you're paying for a babysitter, right? If you want to like pay for a legitimate babysitter that is on the books, right? Or you pay for daycare or any other sort of certain summer camps can qualify for this, right? And so it can be pretty substantial. And if you do this and you're under 29 million in revenue, which most DPCs are, there's even an opportunity to get up to 50% on that. But it can be substantial. As you guys know, a tax credit is a dollar for dollar reduction in tax, not a deduction. So you could be taking, say you spent $3,000-$4,000 on childcare, since it's so astronomically expensive these days. You could take 40% of that and reduce your tax dollar for dollar for an expense that you're already paying for.
Yeah, and the child care credit, this is a unique one, especially since a lot of our DPC owners are hiring uh, people that have children also that need help with childcare. So some distinctions though that are limitations here is you can't claim the child care credit for childcare you pay for as the owner. So if it's for your kids, you get limited, I believe. Sure, you can correct me if I'm wrong there. But for your employees, so like if you have a medical assistant or your front office manager that has kids, a great benefit and way to provide compensation where honestly the IRS is paying for 40% of it because they're going to give you a tax credit for what you pay is this child care credit. So if you provide child care for your employees, either by directly contracting with a child care facility or by hiring like a corporate nanny, you can get a credit against your own tax bill for paying for your employees. And that's one way, like we talk about these ideas of, hey, if you're already spending money on something, can we get a tax benefit for it? Your employees, if they have young kids, are most likely already paying for childcare out of their own paycheck and not getting much of a benefit. So if you as an employer say, instead of a raise this year, I think I want to instead give this new benefit. Hey, look, we can pay for your childcare. You're going to now get a 40% credit for the dollars you're paying into that childcare, up from what was 25%. So that's a huge benefit to kind of pay cash for, spending your cash in a way that's tax advantageous. Then you want to just touch on the individual and family wins?
Yeah, yeah, happy to. So, I know Nate touched on the HSA benefits as they relate to your DPC pricing now. Now that people who do have those HSA accounts can use those tax advantaged funds to pay for DPC, but on an individual level, if this is something that you participate in, or say you still offer health insurance for your employees, or a high deductible plan where you participate in an HSA, you can now contribute up to 8550 for 2025 and 4300 for self, depending on if it's a family or a self or a single HSA plan. So, and if you're over 55, you also get a $2,000 addition to that limitation. So you can contribute substantially to that, and those funds will remain tax free so long as they are spent on qualified health expenses. There's a permanent lower rate, a tax rate now. The rates have been lowered. The brackets of 10% and 35 to 37% at the top end have been locked in. Those were set to sunset in just a few years. And so it's estimated that 62% of filers would have paid more in 2026 without these changes being made permanent. The Trump accounts, this is a new account that was created by the administration and the Department of the Treasury to kind of give an opportunity for younger people to save in a tax advantaged way, right? These operate somewhat, there's a few nuances that we won't necessarily go into, but these operate somewhat similar to a Roth IRA, right? So you can contribute to these accounts. They'll grow tax free. They can't be withdrawn until your child is 18. You can contribute up to $5,000 a year. And if you have a child that was born in 2025 through, I believe, 2028. And you sign up for this. I believe you can start signing up for these in July, but there's a form you can also file with your return that you can talk to your CPA about to go ahead and sign up for this. You'll get a free $1,000 deposited into the account from the Department of the Treasury for that child. A couple of cool things about this that's a little different. You can withdraw these funds to pay for education. You can withdraw them to pay for, or you can roll them over into a retirement account. But one of the things that's different about the Trump accounts than other retirement-based plans is that your child can also, after age 18, withdraw these funds to start a small business. And kind of, it's being used to kind of promote entrepreneurship, to set up children well, in a way that makes the funds inaccessible to the parents, should they face some financial hardship until the child's 18. So it's protected for them, and they can use it to kind of get life started off on the right foot. The last thing is the boosted standard deduction. This has really kind of shot up this year. There's an extra $2,000 for married couples, $6,000 for seniors if you're 65 plus, through 2028. This does make itemizing your deductions less common, which goes back to the increased SALT cap and the PTE that I was talking about. If we can get a better benefit by taking the standard deduction and then continuing with the PTE election at the state level and working with your state on that, we're going to continue to do that. Just because they raised the limitation on the state income tax threshold doesn't necessarily mean that's the best thing for you. So all of these things have to kind of be viewed holistically to make sure you're getting the best tax outcome.
And I'll just give a quick, like hearing that from some of the questions we've got, but like a quick entry level to standard deduction versus itemized deduction. The standard deduction is the deduction that every person filing gets. You can choose to itemize your deductions. And there are specific things that you pay for personally that the IRS will let you write off against your income. That is like mortgage interest, your state real estate taxes, state income taxes. You can write off medical expenses as long as it's over 7.5% of your adjusted gross income. And so, in order for you to even get a deduction, you'd have to have more than 7.5%. So, if you had $100,000 in adjusted gross income, the first 7,500 of your medical expenses wouldn't be deductible. But if you had $8,000 in medical expenses, you could add the $500 over to the rest of your deductions. And then you also have the charitable giving deduction inside of itemized deduction. So if you give to a church or a 501c3 charitable organization, you can add all of those together: medical, taxes, mortgage interest, and charitable giving. And if that number altogether is higher than the standard deduction, then we typically recommend people choose to itemize. Most people don't. Most people don't beat it with their mortgage interest and real estate taxes. They don't have enough in medical expenses, and I hope they don't. It's a lot to have in medical expenses in a year. And so most people, it's like, why wouldn't we take the free standard deduction and then also get the PTE deduction, opposed to choosing to like not get to use the standard at all and have all of our state taxes turn into itemizers? I did see a lot more itemizers this year than I did last year with that change. So what are 5 mistakes we saw in 2025 filing season? Defaulting to Schedule C with no entity analysis. We saw practices netting 150K, still Schedule C, losing over $15,000 a year in self-employment tax because they could have made an S election. A great question to bring to your CPA would be, hey, should we revisit entity structure this year? If they can't give you an answer in terms of what that needs to look like, you should probably look for somebody else to help answer that question for you. Mistake number 2, reasonable compensation was set way too high. Sometimes this happens when people are doing their own tax planning. They just want to make more for W-2s, or Sometimes it's like you set it high because you were applying for a mortgage, and for whatever reason, the mortgage company wanted to see a higher pay stub, but then nobody was like overseeing it and checked back in to make sure you stopped paying yourself that much. Um, and then other times we'll see people that will ramp it up really high because they're like, well, I want to put as much into retirement as possible. That's not a bad strategy. But then what happened was we got to the end of the year, needed to make the retirement contribution, or the person did, and nobody reminded them, or they didn't have the cash to do it. And so we ramped up W-2 compensation all year and then paid all that extra self-employment taxes when we could have backed off, and because we weren't planning to do retirement anyways, and done a little bit different retirement strategy. Mistake number three that we've seen, missing the 100% bonus depreciation timing. Just had people that would put equipment into service, end of 2024 or beginning of 2025 before January 19th, missing the 100% bonus depreciation. Therefore, if it was a high income year for them, some people transitioning fully into DPC have a big W-2 salary that first year. And so timing out asset purchases when you're getting your practice set up can be really helpful to make sure that you can offset that W-2 income from your hospital job or the locums that you were doing. Mistake number four, super common that we pick up when we review people's tax returns, is there's no accountable plan. An accountable plan can be either written or non-written, but it's when you do become an S corporation or a C corporation, you lose the home office deduction and you lose the mileage deduction. So in order to get that deduction and be an S corporation, we set up an accountable plan, which allows the owner to reimburse themselves. So the corporation reimburses the owner for the use of the home, for drives, for clinic errands, or if you're traveling to a conference, like if you went to Savannah this weekend or went to Nashville for the Hint Summit, you could reimburse yourself for all of that stuff from your business, take the money out. You're getting a tax deduction at the business. The money coming to you is a reimbursement for expenses. So you've now essentially transferred money totally tax free out of your business, but we just miss out on it because there's no proactive conversation happening about what are you doing personally that should be for business or be classified as a business expense. So big mistake we often find when we review tax returns. And then big mistake number five is actually QBI deduction. Either people are choosing to be considered a qualified trader business instead of this SSTB. SSTB is worse than the qualified trader business, but it's the right way to do it. So removing that risk. And then also, if we miss out on that new $400 minimum for QBI deductions, being able to do that, we could actually increase, $4,000 to $8,000 in additional QBI deductions by properly classifying and making sure we got the phase-in limits calculated correctly. I did want to do a couple FAQs, and then I want to open it up for questions for you guys as well, if we have any. If not, I'll have one question to ask that might prompt some questions. But can patients pay DPC memberships with HSA dollars? Yes, just not for admin or non-medical add-ons. When should I hire my kids, and what can they actually do? Drew, you want to answer that question?
Yeah, yeah. So we have clients that utilize this strategy at all ages, right? And it depends on your state rules, and so your CPA will have to look into those rules and make sure everything is buttoned down and you're not out of compliance there. But generally, ages 8 and above, 7 and above, depending on the state, they can start, filing stuff, doing data entry, cleaning up around the office, some of those things, depending on your state rules. And then they can also, at a younger age, even than that, they can be involved in social media posts and being somewhat of a baby model. If they're, say, an infant or a toddler, you can have them in advertising materials, have their picture on the website. Some parents are a little wary of putting their child's image out there, so they'll do like a behind the head, like a photo of their child walking on the sidewalk in the back of their head, or kind of work that into the materials so that they're not necessarily putting their child's face out there as much. But all of that stuff qualifies. There's a lot of documentation to go through with this that you'll need to work on with your CPA, but it's a very, very efficient, effective strategy. It's not the biggest tax savings thing we do in the current moment, but it can be huge for your children, right? These are kids who don't have any other income most of the time, right? Say this kid's less than 10, they don't have a job. Say you pay them $6,000. Um, you earned that $6,000. Then you paid it to them, so you deducted it on your business tax return. So you didn't pay tax on it. Because your child is under the standard deduction threshold, they don't pay tax on it, even though they can contribute it to a Roth IRA because it's earned income. And then whenever they retire, they can pull that money out tax free. So it's one of the rarest, it's one of the rare occasions that the IRC allows you to earn money, pass it to another generation, and never pay tax on it. So it can be a substantial thing. And if you do that for several years, your children could be well on their way to a very successful retirement um, just by doing this strategy.
Do you recommend people to actually pay their quarterly estimates? Should they just save it until April because the penalties are small? What do you think,
So I
Drew?
would say, yep. So I'm sorry. I'm sorry. Yeah. So this depends on the person. I would generally recommend paying the safe harbor estimate. A lot of people get a little overconfident and thinking they can out earn the IRS. Um, you're right that the penalties are not that crazy, right? So the interest on a failed quarterly estimate payment would be about half a percentage point a month on average, currently. So it's not a whole lot of money, but if you're just going to sit that into a high yield savings account, you're going to get beat. You're going to get beat. But if you can do that and you can reinvest into your business and you can do some things like that that would maybe produce additional tax savings or build out a better ROI for your business, maybe it's there. Not everybody can do that effectively. So my general recommendation, if I had to give a recommendation to the public at large here, is to pay the safe harbor estimates, but don't give the IRS any more money early. I'll provide a little bit of clarification on what that means. So say that last year, you started your practice, you had net income of $15, right? You pumped so much money in investment, you had a ton of depreciation, and you were just starting to take on patients, so you didn't have very much income. But this year things have kind of blown up, right? Your CPA may give you estimated tax voucher of $4,000. They may tell you to pay $4,000 or $5,000 in Q1, 2, 3, and 4 because they're anticipating next year's tax liability. But in this situation, since you didn't make any money last year, your safe harbor is going to be zero. And so it doesn't make any sense to pay the IRS throughout the year when you're not going to be penalized for not paying in anything. And that works with different amounts, right? Generally, paying in the safe harbor, if you make over $150,000 a year, that's going to be equal to 110% of last year's tax. If you pay in that amount, you're going to be penalty and interest free. Doesn't matter if you wait until April 15th on the day to pay the rest of your tax, you're going to be penalty and interest free. And so if you're in a situation where your income this year is higher than last year, you should base your estimated tax payments on last year's tax. As Nate's saying, continue to put the 25, 30% in a high yield savings account, let it earn for you, and don't give the IRS that interest free loan. But if you say that you had a super high earning, medical um, position in a hospital system or in some other area of practice, right? And you earned a lot of money last year and you're starting your practice this year. If you pay in based on last year, you're going to end up paying way more tax than you need to because your current year liability is likely going to be less while you're getting your practice off the ground. So this is definitely something that you and your CPA should be meeting. I would definitely request to meet with them at least quarterly on this, as we do with our clients, to make sure that these things are dialed in. A ton of CPAs will just give you vouchers whenever you file your tax return, tell you to pay them throughout the year, but that leaves no room to make changes as the year goes on. So you want to make sure that you're doing that.
Awesome. So one thing we started is because of all the questions, but also this idea of like, hey, I've got a CPA that I like working with, but I'd really like getting more insights from CPAs in the DPC world. We started something called the DPC Circle. It's a community for DPC owners who want CPA level financial support without, the full service price tag. Every Friday we do a weekly Q&A, bring questions, share screens, we get real answers. We do monthly deep dive webinars. And so next week, Drew and I are actually going to be going line by line through S-Corps and 1040s to show you specifically where you could look to identify these tax strategies and allow for a lot more, since it's inside of a private community, being able to answer more specific questions. There's also tools and spreadsheets. We have a forecasting tool, break-even analysis, reasonable compensation, entity analysis, tax strategy handbook, all of those things with inside. And then it's tax strategy for you as your practice grows. So if you're in launch, stability, or growth, the right moves at each stage, you can ask those questions. Since we did just launch this, we're doing a founding pricing where you get a discount on the membership for the first, or for the life of the subscription, for being a part of, helping build something really cool for DPC owners that need professional support. And so if you are interested in that, you can go to goodmancpa.com/DPC-community. And we'd be happy to and excited to welcome you into the circle. We always say things happen best in circles. So that's we want you to be a part. All right.
Yeah, Nate. I want to
Go
give one
ahead.
more plug to the circle. So there's a great group of docs in there, and there's a lot of services that we can provide and tools that we've built out in there, as Nate's saying. Nate and the team, everybody's worked hard to put together all these tools. They can help you with pricing and all these sorts of things from our perspective. But Nate has also worked hard to assemble a team of other types of people that you need on your team to have a successful practice. There's marketing people in there. There's med mal insurance people that can talk employer benefits. There's people in there that can help you um, in other areas, right? It's not just financial, it's not just tax. There's a lot of folks in there that can help you be a resource to you. You can reach out to them one-on-one through the circle. There's also a great group of docs in there where you can have conversations with them. They post, they talk about struggles, and it's just a great community to kind of chat and work together, receive resources from us. Maybe you don't want to pay the full price for like an ongoing annual consulting basis type engagement like we typically do, but you can kind of receive a lot of these same services in a group setting and the same advice in a group setting. A little less one-on-one, but you can receive it in a group setting and kind of DIY a little bit of it and still come up with some substantial tax savings and grow your practice.
We just recently had an idea bounce around through the community, where we basically built this DPC calculator that shows specifically how much a person would save if they were to use a DPC practice with using, believe it's Mending, the new insurance group that put out the report of how much people save and employers save when they switch to DPC on medical claims. So even that kind of stuff, we're just brainstorming new ideas on things you could put on your website or materials you could use during your meet and greets. So it's a cool place that we're brainstorming business development, business strategy, as well as tax strategy for a DPC owner. So we'd love to have you a part of it. All right, what questions are there? Let me pull up the chat here real quick. Is Medicare Part A the only requirement for age 55 plus individuals to contribute to an HSA? Man, that's a killer question. If you're talking, Drew, you're currently on mute.
I can touch on that one, Nate, if you want me to.
Yeah.
Yeah, so Medicare Part A, sorry, is not a requirement for an HSA. It's actually a disqualification, right? So there's been some changes that have gone on over the past, I'd say 5 to 10 years, in what qualifies here. But Medicare Part A, I know that that's very applicable to people 55 plus, but Medicare A, B, C, D, participation in any type of Medicare is going to disqualify you from using an HSA, right? An HSA is only allowed for people who have a high deductible health plan and have no other source of insurance or insurance support. So Medicare Part A would disqualify someone from participating in an HSA. So for that person who's 55 plus and doesn't participate, and that's why you see the utilization of HSAs of people at older ages is a little less common. Generally, those people have built that account up over the course of their career and they're still using on it and maybe using it as a a part of their retirement as their health expenses increase. But once they start taking Medicare, they're no longer allowed to contribute to an HSA account. Does that make sense, Rob?
Yes.
Okay, great.
Uh,
Thank you.
A question to prompt the group. If you want to put your answer in the chat, let me see. I'll check Q&As as well. Q&A is good. Okay, in the chat, if you want to go ahead and put in an answer to this question, what's the one thing about your taxes that's been bugging you this year? This is where I start my motivation music, so you can think about payroll for less than 3 employees. DIY versus hire out. Um, yeah, Sida. I think it's if I'm Sida or Sida. Um, DIY is definitely an option. If you want to send me an email, I can send you an invite to Gusto. We get a discount for Gusto and would love to let you use our discount with them. They have a DIY option where you go in, enter your team's hours and amounts. If they get paid the same amount every week, you can actually set it on autopilot, and it will do direct deposit. It'll pull the money out of your bank account, put it into their bank accounts. It'll help file all the tax reports. The place when I typically recommend people to start hiring out somebody to run your payroll is if you have benefits. If you're adding benefits to your employees like long-term disability, short-term disability, health, if you have some sort of supplemental insurance through like an AFLAC where you're doing like cancer or you know the disability and dismemberment premiums, that's where we typically see people's payrolls start getting really funky and the DIY approach starts to fall apart. But Gusto has made it really simple. And if you use their benefits administration, where they're doing all the calculations and deducting from employees' paychecks, it can be a great tool. And then with a discount, we get the 20% discount. It's a relatively affordable way to run your own payroll with only 3 employees. So if you shoot me an email, I can send you an invite to get you into that. Anybody else? What's the biggest pain point about taxes? I was just waiting for somebody to put in there like paying them. That's my biggest pain with taxes is actually paying them. All right. Uh, if you're curious about what you could be saving, like you want an actual dollar number, how much money could I save on taxes? If you go to, you can go to goodmancpa.llc, but if you go to goodmancpa.com/book dash a dash meeting, or if you just go to our website, goodmancpa.com, the first button you'll see is book a strategy call. You'll meet with Matt. He's one of our account executives. He specializes in reviewing people's tax situations and figuring out how much they might be missing. He will give you an estimate of what you could be saving on taxes. That's a great way to be like, hey, based on what I heard, I want some tangibles. You can book a meeting just to learn more about what you're missing out on, or you can jump in with us in the circle, do a weekly Q&A, take advantage of our monthly deep dives and all the tools in our library. Um, really appreciate you guys hopping on. We wish you all the best and success in growing your DPCs. If I can be of assistance in any way, you can email me, nate@goodmancpa.llc, or you can call our office. So we'll pick up the phone. We're not AI. Awesome.
Thanks, guys.
Thanks, guys. I'll send us out with this motivational